Basis questions are really two questions. What kind of asset is it, and what costs belong in basis? Start with classification. Real property is land plus anything permanently attached. Think buildings, farms, mineral rights, and rental real estate. Everything else is personal property, including vehicles, equipment, household goods, and even intangibles like stock or crypto. On the EA exam, they'll test whether you can sort these fast. Here's the classic trap. Personal property is not the same thing as personal use property. Personal property is a legal category, movable stuff, whether used in business or not. Personal use property describes how you use it, for personal life, not for business or investment. A laptop can be personal property either way, but if it's personal use, losses and deductions often get limited, while business or investment property gets different rules. Now basis. Your starting point is usually cost basis, what you paid. But sometimes basis comes from fair market value instead, like inherited property with a step up at death. And certain transfers, like between spouses or incident to divorce, generally carry over the old basis. Exam tip. When you see inheritance, your brain should immediately ask, is basis FMV at date of death? To build adjusted basis, you add capitalizable costs. These are costs to acquire the asset, get it ready to use, or improve it. Common adds include sales tax, freight-in, delivery, installation, and testing. For real estate, if the buyer pays delinquent real estate taxes owed by the seller, that amount can increase basis. And major improvements, like paving a driveway, get added because they extend life or add value. Legal and accounting fees can be basis too, when they're tied to acquiring or defending ownership. The weird but testable rule: legal fees to defend or perfect title aren't currently deductible, but they increase basis. So if you buy farmland and later pay an attorney to defend your title, your adjusted basis goes up by those legal fees. The exam loves that distinction: capitalized versus deducted. Two quick mini examples. Buy a car for $15,000, add sales tax and delivery, and that total is your basis. Buy a home for $120,000, then add a $6,000 driveway improvement, and your adjusted basis becomes $126,000. One more exam favorite. Stock splits don't change total basis. They just spread the same total basis over more shares, lowering basis per share. Which of the following items does not decrease an asset's basis? Choices include the cost of defending title to the property, Section 179 deductions, a casualty loss, and a manufacturer's rebate. You're looking for the one that does not reduce basis over time. Think about what gets capitalized versus what's treated like a reduction in cost. Think about it. The correct answer is the cost of defending a title to the property. Those legal fees are capital expenditures, so they increase basis instead of decreasing it. A tempting wrong answer is the manufacturer's rebate, because it feels like income, but it usually reduces the purchase price, which reduces basis. Section 179 and casualty losses also reduce basis because you've already gotten tax benefit. Marisol received 500 shares of restricted stock from her employer on March 1, 2023, but she forfeits the stock unless she completes 5 years of service. On March 1st, the stock's fair market value was $15,000. How much does she include in income in 2023, and what is her basis in the stock? Options range from income now with basis now to reporting nothing until the service requirement is met. Think about it. The correct answer is that she generally reports no income in 2023 and has no basis yet, because the stock is subject to a substantial risk of forfeiture. Taxation and basis usually wait until the stock becomes substantially vested. The tempting wrong answer is including the $15,000 now, because you see an FMV number and want to tax it. That would generally require an 83B election, and it's not mentioned here.